Hey, welcome back to the Consulting Mind. Today I'm going to provide you a short brief on the Fed new monetary policy initiative in July FOMC meeting, which is about the standing repo facility. And I'm going to walk you through what had happened, why now, and what will be the next. So what happened is that the Fed has set up two new standing repo facility. One of them are the Domestic Standing Repurchase Agreement, the SRF, and another one is the repo facility for foreign and international monetary authorities, the FIMA. So basically, you can consider one of them is for domestic and internal use, and another one is for external and foreign use. The claim purpose for these facilities are to serve as the backstop in money market in order to support the effective implementation of monetary policy and for the smooth market functioning. And we are going to examine this claim purpose soon. So now, let's further talk about what exactly it is. Fundamentally, both of the two, including the domestic one and the foreign one, they are both meant to be designed to be sort of emergent liquidity arrangement, meaning that they were only meant to be used during some critical period, like some period of credit crunch. There are extremely lack of liquidity in the market, and they were meant to be ended and ceased when the crisis is over and back to normal. And what now the Fed is trying to do is that they're going to turn this one-off temporary arrangement to a regular one, meaning that they will be standby every day. So for the domestic standing repo facility, the SRF, the initial rate was set at 0.25%, 25 basis point, and it was kept as US 500 billion. Of course, this amount can be addressed very agilely when they saw the need. And they were open to the 24 primary dealers for now. And for the FIMA repo facility, they were designed for those foreign central bank and other foreign monetary authorities, where they can raise dollar simply by selling the US treasuries to the Fed, and then they're going to agree to buy them back at the maturity. So now we can back to the purpose and objective. The forward claim of the monetary initiative described by the Fed is for smoother market functioning. But in my opinion, that is kind of invalid, or at least they did not spell out the real objective or the hidden agenda for this too. Because my view is that the Fed is trying to prepare for the next credit crunch, especially tapering can be happening soon. So, as the Fed mentioned that inflation might be transitionary, but then you can see from the recent month CPI data, the inflation data, it is highly likely that the inflation might not actually be transitionary, especially if you take into the weather, the supply chain, the Delta virus factor into consideration. So, very likely that the inflation might be even getting more higher, or at least it will not go down in the second half of this year. So, when the inflation is coming, and when the Fed is going to exit the QE, do the tapering, if there is any credit crunch or if there's any crisis that lead to the demand of the liquidity, the Fed will be in a very embarrassing situation where, on one hand, they cannot override their previous claim that the inflation is transitionary and then continue to print money. But on the other hand, they have to save the economy or save the market. So for now, they will have to prepare for that, and they will have to find out a sort of new initiative beyond QE to provide sufficient liquidity for the market, which I think is this standing repo facility. So then your next question might be, so is that another form of QE for the SRF? Basically, it depends of your interpretation, but it can be yes and no. So let's do a very quick comparison between QE and repo in some critical areas. So for one, in terms of the setup time, QE, the setup process is relatively longer, slower, because you can imagine or you can recall that every time when the Fed is going to do any sort of QE, they will have to get the Congress buy-in. They will have to sell the Congress to approve that. There are some debate period, some approval process, and they will have to face with the political debate, political struggle, or political factors in launching the QE, like the moral hazard, whether it is right, it is okay, is it correct to do so, whether it is have any negative impact of the general citizens' interest, sort of that. But then on the other hand, for Ripple, the Fed can set up it much more faster because basically the Fed, you can say that they have the full authority and the power to set up those Ripple facility. When they saw the need to adjust the Ripple facility, like increasing the amount or adjusting the Ripple rate, they can do it by themselves. They do not have to get any sort of approval or consensus from the Congress. So this is for one setup time. Ripple is much more faster than QE. And for another one, in terms of the exit barrier, I think you will understand that the QE exit barrier is extremely high, because you can think about that. Whenever the Fed nowadays is trying to release any signal of tapering or testing the water from the market will be scared. They are feared that the liquidity is running out soon, and then the market will crash, and then the people will run away from the market. So every time when the Fed, not to mention actually exiting the QE, whenever they are trying to mention that, implying that they are going to do so, the market will be very fear about that. So the exit barrier is quite high. But then on the other hand, for Ripple, the exit barrier is relatively low because fundamental it is more agile and more flexible. For one, it is conducted on a daily basis. So when the Ripple period is over, naturally, the Treasury will be back to the borrowing party, and the money will be back to the Fed, which in nature, the impact on the market will be relatively low. So for the last factor, the impact on the balance sheet. For QE, the impact of balance sheet will be more larger and static. What does that mean? As mentioned before, QE is sort of a tool that is hard to exit. So you can see nowadays, after round of QE, after consecutive month of securities asset buying on a monthly basis, the US Fed balance sheet has now expanded to over $8 trillion, and it cannot be go down for now. So this will cause a quite large and static impact on balance sheet. But then on the other hand, for Ripple, it will cause a temporary increase on the balance sheet. But then, as mentioned before, since it is conducted on an overnight basis, when the need is over, the fund will naturally back to the Fed balance sheet, and then the transaction will be offset with the counterparty paying back the money to the Fed, and then the Fed paying back the securities to the borrowing party. So in nature, Ripple will be more agile, and it will bring less impact of the Fed on the balance sheet. So this is, in my opinion, why the Fed will favor Ripple over QE now, considering this type of features. So what next is that you have to be very careful and very conscious about the inflation trend. It will be a very key leading indicator on the Fed monetary policy or the initiative in the second half of this year. And another one is you will also have to keep an eye on the general economic figures like the employment statistic, the import and export data, to have a feeling about the US overall economy, whether or not it can still be expanding or back to normal in facing the Delta virus. And the final one, which is also a very critical one, is you will have to be very cautious about what Jay Powell will be saying on the Jackson Hole meeting. It will be a very, very strong indication of the Fed monetary policy in the next second year. So this is it today, and I hope this can help you to understand why the Fed is launching this tool at this very particular moment. And if you think the video might be helping you to get a better understanding on that, please click the like button and subscription button for me. Thank you, and see you soon.